The energy market is moving again, but is it still a good time to be thinking about these as long-term investments? Joining us today is one of our energy experts, Marc Lichtenfeld with the Oxford Group. Marc, so glad to have you back on the show. I know you've been on a few times talking about energy over the last year or so. The last time we had you on talking about energy stocks was the very start of March, which was also the start of this Iran conflict that's really been moving the energy market ever since. So let's talk about from the start of that conflict to what seems to be a move towards peace, or at least that's what we hope. How do you think that the oil market and the energy market could be reacting to what's going on geopolitically right now?
Well, it's interesting. It's almost as if the oil market is really discounting a lot of the headline news. So, for example, about a week ago, the president, as he often did, announced that they were close to a peace deal. But then the following day, violence continued, and there was some more bombing for the first time in a while, actually. And oil prices actually sold off a little bit. So it seems as if at this point it is, truly the financial fundamentals that are driving oil prices as opposed to simply headlines. And I think what it means is, and you're probably very aware of this, as are your viewers, that even once peace is achieved and they open up the strait, it's not like you just flick on a switch and suddenly all the oil is back in the refiners and everything goes back to normal. It's going to take months and months for everything to return to somewhat normal levels. So I think that is what the oil prices are pricing in, and that they could certainly come down as a result of peace, but I don't think we're going to go back to the $50, $60 oil that we were at, 6 months ago, or what have you.
And that is why we are going to be looking at three different oil energy related stocks, new names to talk about today, and why now is an interesting time to be looking at them, especially as a potential long-term investment for your portfolio. We'll get into those three names in a minute, but I want to talk about the three energy stocks that you talked about back in March when we had you on the show talking about energy, and how well those three names have done in the market since then, even with the pullback that we've seen in energy the last week. Let's talk about those names. I mean, the performance has been really great.
It's really no surprise because we have seen oil prices rising and investors starting to pay more attention to energy after the sector really had been beaten up for quite some time. So Enterprise Products Partners has performed very well, and they just reported a strong first quarter. Again, not too surprising. Distributable cash flow is up 5%. They easily cover their dividend. They have a really nice dividend yield, as you know, I like dividends. So they have a 5.8% dividend yield, and that distributable cash flow is almost double of what they pay out. So it's not going to be any problem for them to continue to pay and raise their dividend as they have done for over 20 straight years.
Right. That one had solid performance since we talked about it back in March. The other two names that we talked about, if you look at the charts, you can see right after that, both stocks spiked significantly, again, just in a 2-month period. At one point, APA that you talked about was up over 37% before it started to pull back. It's still up almost 15%. And again, that's just in a 60-day timeline. So let's talk about what about those names. Is it just the Iran conflict that boosted those so well in a short period of time? Or are there other fundamentals that you're looking at when recommending these energy stocks?
Yeah, so APA and Marathon Oil, those are the other two. So those are really margin stories. APA has been cutting their capital expenditures. It's expected to cut by about 10% this year. And Marathon Oil also, refineries, when oil prices are volatile and especially going higher, their margins increase. And so naturally, as these oil prices are growing, that's really boosting these companies' margins. Now, even if oil prices were not spiking or hadn't spiked back when it did, I really like these because these were going to be, margin increase stories. And so anytime a company is able to grow their margins, that's positive. And then when oil prices increase, that just, compounds the margin expansion as well. So that's what I really liked about them. And even if oil prices didn't rise, I think there's still really good stories. APA, very, very good value. It's still trading below 7 times forward earnings. So really, really cheap stock. And I think there's a lot of potential still left in these names, regardless of whether oil prices, continue to rise. If they fall, obviously, rising oil prices will be better for these stocks and their businesses. But the fact that they are growing their margins is really important.
Yeah, that leads me into what we're going to be talking about with the new list you have and these other three names that you talked about. We can see they're all on a pullback right now. So share a little bit about your thought process on getting into these energy and oil stocks right now when we're starting to see that pullback and the potential for a pullback in oil prices if that does happen.
I think what's important here is when the war started, prices spiked. Yeah, people quickly turned to energy stocks. But generally speaking, everyone is still so focused on technology for good reason. Technology stocks have been white hot, but it's going to be the energy companies that allow all these tech companies to run in the future. I mean, they're expecting about 3.5% annual increases in the demand for electricity in the United States through 2030. That's actually quite a big number when you think about electricity demand. It's kind of like, thinking about the picks and shovels idea, which goes back to the gold mining days, where certainly some people struck gold and got to shout eureka, but it was the companies or the businesses that were selling the picks, the shovels, the Levi's jeans, that were the ones that really made a lot of money. So with technology, with AI, I see energy as kind of that picks and shovels business. Yes, the technology is exciting. There is going to be money to be made there, no doubt, but you're going to need energy and a lot of it in order to fuel these businesses and allow these data centers to run.
Yeah, this is one of the biggest bottlenecks in the market right now for actually making that AI work. So the tech that everyone's so excited about depends on energy, and we haven't seen some of these names rise as quickly as the demand that's out there would show that they should anyway. So we're going to get into these three names that you're looking at now that no matter what happens with the conflict or the price of oil, there's still a ton of potential in these names, and right now they seem to be pulling back. Another benefit of all of the stocks that Mark and his team at the Oxford Club look at is these are great long-term investments because of the dividend. As Mark already mentioned, he is absolutely a huge proponent of dividends, and he has a special report he's offering for free just for our MarketBeat viewers today. This is the top 12 dividend stocks that he recommends for the people in his program. So you can scan the QR code or click the link in the description to get that free report right now from Mark and his team at the Oxford Club. All right, Mark, let's get into your list now, the new list of energy stocks for today. What's the first company that you're looking at?
So the first one is Halliburton, and it has the lowest yield of the stocks that I'm talking about. So 1.7% yield. So, you're not investing in this one, just for the dividend, but it does have a nice little dividend to go along with the capital appreciation. The stock's been in a really nice uptrend all year. So it hasn't just been the spike in oil prices from, a few months ago that have been responsible for the stock's gains. It's just in a nice steady uptrend. And I love stocks that are just kind of slowly climbing up and to the right. That's kind of a very sustainable move versus, something that just spikes higher and that you hope will continue. They have increased activities outside the Middle East, so they're not reliant on the Middle East. They do a lot of work in the United States and offshore of the United States. So that's really important because you certainly want to diversify your risk and not be super concentrated in the Middle East. They are involved with fracking in the US, and we know that the president and the industry and Americans want oil and gas coming out of the ground in America, especially after what we just saw in the Strait of Hormuz. It's more important than ever that we're self-reliant in our oil supply. So now, to be clear, they provide the equipment, the personnel for the oil drillers. So they are not the Exxon Mobils that are pulling the oil out of the ground. They're the ones providing the equipment to do it. So as long as all the big oil drillers are doing that, they have to get their equipment from somewhere, and they get it from companies like Halliburton. Their earnings are projected to grow 23% this year to $2.91 a share, and then another 15% in 2028. So this is very much an earnings grower, and they're only trading at 16 times earnings. And if you think about it, if this traded just up to 20 times earnings, which is not an exorbitant value. And if they earned, let's say, just $3 a share, which is less than the consensus estimate for 2028, then we're talking about a $60 stock. So it would be a really nice move. It's not a double or a triple in a couple of years, but it would be a pretty impressive move for a big company over the next 2 years.
Yeah, this is really a picks and shovels play in the oil and gas sector as well. Like you said, they provide the equipment that's needed. And we had some guests on the channel just a week ago who were talking about rig count numbers and how this is the first time in over 4 years that we've seen the number of new oil rigs being built in the U.S. increasing. So exactly what you mentioned of that move towards onshoring more of our oil supply to the US means that there's more money going into building these rigs. The big oil companies are making that investment. And even if the oil story and oil prices change, that investment's already underway, which means Halliburton will be getting paid, right?
Absolutely. And, these things typically lag a little bit. So as oil prices are high, naturally oil companies want to drill more. So they get into these contracts with Halliburton and other companies. When oil prices decline, it takes a little while. So even if peace is achieved, even if oil prices fall, it's not going to be like suddenly the switch is turned off for companies like Halliburton. These things take a long time. They're pretty long cycles. So I do like this for the short term as well as for the long term.
Yeah, let's talk about the recent volatility. I've really just, like you said, it's been up and to the right for quite a while. Over the whole last year, it's up over 90 some percent for a large company. That's a really good year increase. But let's talk about the pullback and the volatility it's seen really around these headlines with Iran and what's happening with that conflict in oil prices. Do you think it's a nice entry point? Could we see even more of a pullback as more headlines come out over the next few days and weeks?
Yes to both. I do think it's a good entry point. I think it's very, very difficult to time the market, whether the market or an individual stock. Certainly, there's some technical indicators you can look at, things like supports and resistances. But if you're trying to base it on headlines, very often the market will do the unexpected, and so peace could be achieved, and theoretically, oil prices should fall on that news. Doesn't always work that way. So it's very, very difficult to say, well, when there's a peace deal, oil prices are definitely going to come down, and this is the effect it's going to have on these stocks. I think you want to look at them, especially these kinds of stocks for the long term because of, as we discussed, how in demand energy is going to be. Even forgetting AI for a second, you've got an increasingly wealthy global population, more and more people, millions and millions of people entering the middle class all over the world. So you would need more energy for that. Now you layer in AI on top of that, and the demand for energy long term is going to be very, very strong. So I think it's a good time to enter now. You could always, position size, put in, half a position or a quarter position, scale in at some point. But I don't think you want to miss this opportunity in case this uptrend continues and lifts off from here, because again, this stock isn't an uptrend. It has not broken. If the stock had rolled over, I would say, yeah, maybe let's wait a little bit and see if we can get in cheaper. But right now, that's not the case at all.
Yeah, Halliburton, a great company to look at. Again, more of the picks and shovels side of the oil and energy story. Let's move on to the second stock in your list, and this is a different side of oil for sure.
So Chevron, so they are the kind of company that would employ Halliburton, so one of the major oil producers out there. Really nice yield, 3.9% dividend yield. They've been raising it forever. I really like the fact that they have exposure to Venezuela. They, somewhat of an untapped market, and they're pretty much first in line in Venezuela. They've had operations there for a while. Right now, Chevron is clearly one of the giants. They produce about 4 million barrels of oil per day, which is between like 4 and 5% of the world's production every single day. That's a major, major number. So they're a very, very big player, obviously. They completed an acquisition of Hess in 2025. There's a lot of things to like there, but what I really, really like here is that it gives them one of the highest margin oil fields in the world off the coast of Guyana. So it's one of the lowest cost and highest yielding oil fields. So that's going to boost their margins, their earnings, their cash flow. They recently signed a deal to supply gas to Microsoft data centers in Texas. So not only are they just a giant, oil producer, they're also in that getting into the AI game as well with, one of the biggest players that are out there. Less than 5% of its production is in the Middle East. So really love the fact that they are not reliant on that part of the world either. And pretty reasonable valuation, trading at 13 times forward earnings and 7 times forward free cash flow. Generally speaking, I like companies that are trading at 10 times or less cash flow, free cash flow, and they're trading at 7 times free cash flow. So it's a pretty good valuation at this point.
Yeah, I think one of the biggest growth factors you mentioned there that is so interesting is that they're having a direct partnership with Microsoft, one of the major hyperscalers out there. So there's many investors who are not counting in oil and gas energy companies as a part of filling that, huge electricity demand that we're having and the huge power demand that we're having. But it does have to come from somewhere. And I do think that a lot of companies are getting creative with using the traditional energy methods we have, oil being one of them, to fulfill the needs that these data centers are having. So I think that could potentially be a good growth driver for not only Chevron, but other companies in this field as well. I want to talk about timeline. So a lot of investors who are interested in tech are seeing these tremendous overnight returns, right? Up 200% in a month from massive growth stories in the tech sector. I don't think you're going to get that kind of overnight success with Chevron, but what kind of long-term growth horizon do you see and a timeline for growth and growing your portfolio, not only from the stock, but also from the dividend yield on a company that's solid like Chevron?
Yeah, so I don't have a specific price target or return. I do expect it to outperform the market. This is, one of those you put in the portfolio and 5 years from now, 10 years from now, you look back and it's one of those stocks that have really compounded and helped move the needle in your portfolio. So, this is not, like you said, a tech stock that's going to explode higher. It's a nice, solid, steady as she goes, long-term growth story.
And as retail investors, I think that it's exciting to pay attention to those explosive growth tech stories or the space stories that are seeing that explosive growth right now. But I think this video is so important right now in the timing because you also have to have some diversification with some of these more solid companies that are continuing to see that slow growth and success over time. That even with headlines like what's happening with the conflict right now, they won't massively impact a stock like this. It's still very solid, has the solid books like you talked about. So I think it's great to remember names like this one.
Yeah, and this is, this would also, I would consider this a defensive name as well. So right now, market is on fire. Everything looks wonderful. It's not going to stay that way forever, as we know. Markets, bear markets are just a part of the regular cycles of bulls and bear markets. Eventually, that's going to occur. We're going to have a downturn at some point, and having a quality defensive dividend growth company like Chevron in the portfolio can really help, steady the portfolio if some of your more speculative names, some of the higher momentum and growth names start to take a hit. Having a stock like Chevron, makes it a little bit easier to weather the storm.
Yeah, I think that's such great advice for investors to keep in mind. And I like that we're talking about it now when a lot of the market is booming. So often we do videos like this, or people want to hear videos like this when we're in the middle of a crash. But I think now is the time to be talking about those names, just preparing for the inevitable, because you're right, the market cannot go up and to the right forever. We can't see explosive growth forever. There will naturally be some pullbacks and corrections at some point. So a great name to talk about now. If you are interested in more names like this, those solid dividend companies that can help, support your portfolio through whatever the market brings over the next few months, make sure to check out Mark's free report with the top 12 dividend stocks that he is watching right now that are exactly that, the kinds of stocks that can help support your portfolio and protect your investments for the long term, not just during short-term growth moments and momentum moments in the market. Scan the QR code or click the link in the description to get that free report. Again, a special offer just for our MarketBeat viewers today. All right, Marc, let's get to this last energy stock that you are looking at. And this is not quite as popular of a name as Chevron anyway.
Yeah, and this is kind of the opposite of Chevron. This is a bit more speculative, has more momentum on its side, and that's Hannon Armstrong Sustainable Infrastructure, ticker symbol HASI. And this is a company that lends money to renewables projects, so solar and wind. And what I find fascinating about this stock and the sector, quite frankly, is it's no secret that President Trump has been coming after the renewables sector. He and the administration are doing, whatever is possible to shut down solar and wind projects, and yet the sector has been on fire this year. It is completely shrugged off any kind of policy that has been aiming to slow it down. And to me, it makes all the sense in the world because regardless of, let's say, short-term policy, we need all the energy that we can get. As we just talked about with AI coming on board and increasing, we need so much more power. And yes, oil needs to be a big part of that, and that's why we're increasing drilling. But to not think that solar and wind are going to be a part of that. We need all the energy we can get. We need nuclear, we need oil, we need gas, we need solar and wind. Whatever we can bring online to feed this beast is important. So I think the market clearly understands that regardless of, whatever is coming out of Washington. And these companies are doing quite well, and they're so a company like Hannon Armstrong. So again, they're the financiers of these projects. So they're not building the solar, they're not collecting the revenue from solar. They're simply collecting the interest from the companies that are building it. And their portfolio is absolutely fantastic. They generate or they pay out about a 4% yield. This is a $6 billion market cap company, so not real big. 4% yield. The stock has nearly doubled in a year. So it does have momentum. It's trading at less than 12 times its 2028 guidance. So really, really cheap valuation despite the big move in the stock. They raise money right now in the mid-single digits, meaning they're paying, let's say, 5 to 7% to borrow money and then lending it out at about 10% roughly. As interest rates go up, that will move a little bit as well on both sides. They may actually see their cost of borrowing go down because they just got some upgrades for their credit rating. So they are a triple B minus credit rating, which is investment grade. So they're a very, very safe company. If you were going to buy the bonds, I'm recommending the stock, but if you're going to buy the bonds, the credit agencies are telling you this is a very, very safe company from a credit perspective. Earnings projected to grow double digits through 2028. They're a very diversified portfolio. They have 1,300 different investments with 150 clients. Some of those are very long-term contracts. A few of them are 30 years. So, they can really count on this cash flow to come in and be able to pay the dividend, hopefully raise it going forward. And let's face it, if 2028, winds change in Washington, then that will be a huge tailwind for this sector. Granted, that's 2 years away, but that is a potential catalyst for the sector and the stock.
Yeah, there's always changes in Washington that could impact the energy sector because of policies. That is for sure. But I think what you said is so true that no matter what policy is happening in Washington and which sector of energy they're supporting more than the other, there's so much demand for energy right now that all of them are winning. And there is room for all of these sectors of the energy market to do well right now because the demand is so extreme. I think looking at these solar and wind projects as a potential growth, clearly they're making money or they wouldn't be building more of them right now. Is there a lot of competition out there, or does this company really have a niche in the market for funding these kinds of large scale renewable energy projects?
There is competition, but they are certainly one of the most well-known of them. They focus on projects in the United States. And so, being a publicly traded company also, and they have access to capital, perhaps a little bit easier than some private companies. So I would say they are, I don't know if they're the 800-pound gorilla, but they're a large gorilla in the space for sure.
Yeah, I also want to look at their earnings report really quick because it was fairly recent, just towards the start of May. It looks like they have some really strong numbers coming in too. I know you touched on a few of those details already, but I think it's enough to highlight too that they're clearly the money is coming in for this company.
Yeah, absolutely. They are generating great numbers. Like I said, they're paying this nice dividend yield. That dividend yield should grow over time, and the fact that they have this very high credit rating means that their access to capital should be, less expensive than many of their competitors. So I really like that fact that their cost of capital is likely much lower than competitors. And I think that's a story that not a lot of people are talking about.
Yeah, for sure. This is another unique name to look at in the energy sector, less tied to the oil price story that's currently in the headlines, too. Like you said, it's kind of a quiet area of energy to be looking at right now. Mark, another great list as always. Thank you so much for coming on the show to share some of these. If you want to, we'll go back and watch that full energy video we talked about in March for some more details on the three names we talked about early on in this video. You can watch that full interview here.